About a year ago to the day, I was listening to a podcast while on a run, while on paternity leave. And the episode that came across my speakers was an interview featuring a guy named Sean Ellis. Had no idea who he was. Gave it a chance, I listened to it. It was a really long run. It was about an hour-long episode, I think, on Lenny's podcast. And I remember sending a text to two guys on our team, Garrett and Andrew, saying I think about growth fundamentally differently now. It changed the way I thought about how a business grows, that episode. It changed the way I thought about how we can grow the business of ADDO. And it changed the way I thought about how ADDO supports our clients in growing their business. I hope that this session leaves you as excited about what's possible from a growth perspective in your business as it does me. Sean Ellis hails from the West Coast, has had international stints, but he's a growth expert that helps brands identify and optimize their greatest growth levers. He's done it for brands like Dropbox, like Upwork, like Eventbrite, like LogMeIn, and more. And before I steal his talk, which I feel like I've almost memorized at this point, please welcome to the stage, Sean Ellis.
Well, good morning. Nice to be here with all of you, and thank you very much, Aaron, for the kind introduction. So, I think what Aaron didn't touch on is that most of my work is in really early stage technology companies, and so I'm not used to spending time with much more established brands like yourselves. But I think when Aaron read my book and when he heard that podcast, he thought there was something that would be some fresh thinking for you guys, and so hopefully through the next period of time, we'll do a Q&A session afterwards that we can dial in and really figure out what are the relevant parts to each of you so that you can come away with maybe some new tools to accelerate growth in the business. So I'm going to be talking about why great execution is only part of success, and a lot of it's going to be focusing on how markets shift. And so I want to start with just a thought exercise for you. If you think back to a brand that you had really strong loyalty to, and then one day you discovered something that was a lot better or met your needs a lot better, and suddenly that loyalty evaporated. So just think for a second about a brand where you experienced that. So for me, it's BlackBerry is one of those items. I don't know if any of you were tapping away on emails on your BlackBerries, but it seemed like the greatest thing on earth when it first came out. It was, email was my primary use case on my computer, and suddenly I could crank out emails just as fast on a device that fit in my pocket. It was absolutely amazing. And so, the idea of touching a glass screen to do an email didn't make sense for me. But I was actually skiing with a friend of mine when I found out that one of my marketing campaigns was going a little haywire and I needed to pause the campaign. And of course, I didn't have my computer with me skiing. So I was in a bit of a panic, and the guy who I was skiing with said, try my iPhone. Maybe you can figure out how to pause the campaign with my iPhone. So I took his iPhone, very easily logged into the website, very easily paused the campaign, and my entire view shifted, and suddenly I was an iPhone guy. I went out and got an iPhone soon afterwards, and you can see, I think that pattern repeated for a lot of people, and for BlackBerry, suddenly the market had shifted on them, and it was part of their process of essentially on the path to irrelevancy. And so markets shift all of the time, and it's not that BlackBerry was necessarily executing any differently or executing badly. They just missed the market as it shifted. And I think that's one of the things that I want to dig into today is how do you track when markets shift and adjust to that and build that flexibility into the business to be able to capitalize on the new opportunities that emerge from a market shift. And so that's what we'll focus on particularly. And just it comes down to this idea that great execution is only part of success. You can execute just really well like BlackBerry did, and then suddenly one day that execution doesn't matter as much. And so we often think that companies decline because the execution declines, but there's often other forces at play that suddenly make it a lot less relevant. And so when the market shifts, execution is not going to be able to save you from that fit. And so what in the startup world we refer that to is product market fit. So I don't know, have any of you heard that phrase before, product market fit? So I see some nods, but it's if I ask a room full of startup people, that's the word that they would have heard probably more than any other kind of phrase, because it makes sense as new technology is coming to market. Most of the time, people don't know what the heck to do with it. There's kind of like, just because it's innovative doesn't mean it's valuable. And so product market fit is the thing that new technology has to dial into to even have a chance to grow. But we think of it as a milestone in the startup world because essentially, if you don't have product market fit, your chances of success are almost zero. Once you cross into product market fit, then it comes down to execution. But for all of you, product market fit is a lot less about a milestone. It's about staying in sync as the market shifts over time. And so that's what I want to talk about, and how you can revalidate that product market fit over time and continue to maximize against the opportunity that evolves. So why do markets shift? There's really three key forces that are happening. One, expectations rise. Everyone's raising their level of execution and customer service. And so whether it's in your industry or in other industries, people start to expect more. But really it's the second force that's probably the bigger force, is that choices expand. You know, that was the one that affected BlackBerry. It wasn't that the expectations necessarily shifted too much from a customer service perspective. It was that I now experienced new innovation that made me reconsider what my needs were. And so choices are constantly expanding for people, but then tolerance also shrinks. That if you don't get what you need in a product, maybe initially you're the one that innovates, but as we know, everybody copies everyone else, and pretty quickly your innovation is not that differentiated. And when it's easy to shift to something else, that your forgiveness level, the customer's forgiveness level or the guest's forgiveness level drops significantly. And so all of these forces are working against us to be able to just rely on pure execution. So I did a trip 2 years ago, a book tour. My book, interesting, is probably more popular outside of the US than it is in the US, and in China in particular. We sold 600,000 copies in China for some reason. So I did a tour to kind of try to accelerate book sales and capitalize on all the awareness that was out there. And one of my biggest surprises on the tour was that almost every successful entrepreneur that I met in every country told me this question was game-changing for their business. And some of you may have seen this question, but it's essentially asking customers on the product, how would you feel if you could no longer use this product? And then giving them the choice, very disappointed, somewhat disappointed, or not disappointed. And so when I run this question, I am only interested in people who answer very disappointed. They're the ones that say, this product is a must-have for me. If they say, I would be somewhat disappointed without this, when I dig into why, usually they feel like I would just use product X instead. So when they think there's a really easy product to shift to. So this question is what I use to validate product market fit before I go into a Dropbox. So when I joined Dropbox, there were 8 people. I was the first non-engineer at Dropbox. This question helped me to validate, okay, there's really something here. And so Dropbox went on to become the fastest growing SaaS business to reach $1 billion in recurring revenue. And a lot of it was just the deep strength of customer passion in those early users that were there. And so for me, what I'm looking for is some segment, some identifiable, targetable segment that's above 40% that says that they would be very disappointed. And then that's when I know I have the raw ingredients to be able to drive growth in the business. And so we'll come back to this question through the presentation here, but keep that one in mind. So, I've already touched on BlackBerry, but we've seen product after product over the years suddenly lose that fit. Blockbuster, especially when it's created by AI, a slide, Blockbuster in this case, which I didn't notice until last minute. But yeah, I remember back to taking my kids to Blockbuster, and it was an experience. You know, we're all looking through the movies, and there wasn't really anything wrong with Blockbuster. I would say there was a bit of an annoyance when you forgot to return the movie, and suddenly it's you get these big fees associated with that. But it was just more of a minor annoyance. But when Netflix came onto the market, that minor annoyance was really what they went after, was this like no late fees. And it wasn't that much more convenient. It was a little bit weird to have to wait in the mail for the DVD to arrive, but at least you had no late fees. So that was like maybe their wedge initially. But obviously over time, they moved toward video on demand, and then suddenly it became convenient and just better. And before you know, Blockbuster didn't respond. They had a chance to buy them. They had a chance to kind of match their offer, but they missed the tea leaves as the market was shifting on them. For me, I was a big fan of Beyond Meat because I love beef, but I stopped eating beef a few years ago, and I thought it actually tasted as good as beef. I moved to it for health reasons, and then people started talking about, you know, we should avoid processed foods, and like, oh, maybe this thing's super processed and high in sodium and some of the other kind of negative pieces. And at least for me, that's what made it lose product market fit. I don't know for other people necessarily what happened, but over time, obviously, I think they're 1% of their peak value of where they were. They're now a penny stock. And so that's more of a changing taste that took them out of product market fit. But we see lots of stories like this where the market moves and the company didn't move with it. And so when that happens, execution is not going to help you when you have outdated assumptions about why people need your product. And so ultimately in the startup world, there's been a study that was out there, I think it was already probably more than 20 years ago, but it was called the Startup Genome Project, where they studied all of these startups, and the number one thing that caused startups to fail was trying to scale before they had validated product market fit, because it costs a lot of money. You suddenly have all the operations of trying to scale, and if you can't retain those customers because they don't really need your product, suddenly you burn through a lot of money, where you can operate a lot more cheaply while you're innovating and iterating the product to try to dial it in. But if you're an existing brand and you slip out of product market fit and you're just trying to throw more and more at marketing, you're probably not going to be able to scale either. So I think the principle applies there as well. But we all know execution is really important. I think in my experience, execution often comes down to more activity feels really good. We've got all these things going on, and we're trying to drive growth in the business. And of course, we want to understand what works and what doesn't work and have those feedback loops, but more is generally better in most people's mind. But again, if you don't have that product market fit in place, it's not going to help you that much. So ideally, when you think about execution, it should really be more about figuring out what works and what doesn't work, and being able to double down on the things that work and start to eliminate the things that don't work. So execution is really an engine of continuous learning. And fortunately, in the digital world where I spend my time, I have the ability to see pretty clearly what's working and what's not working. It's a little harder with traditional brands, but for me, that's the ability of the more tests I run, the more things we try, the more I figure out things that actually work and don't work. But it's not just from a data perspective. I need that qualitative feedback loop as well that tells me, am I slipping out of product market fit? Why does this segment like us? Why does this segment churn so quickly? But that execution is all about maximizing the learning. So I want to come back to this concept of product market fit and just tell you a specific story of one of the companies that I worked with. And it's a company called Lookout, which is a mobile security company. And I'll tell you about the time when I was there, but how some of the learning and the things we did helped them navigate a very fluidly changing market so that they're still relevant today. So when I joined Lookout, it was 2009, and they had essentially looked at Android devices, and they knew Android devices were really vulnerable to attacks. So whether it was to viruses, to people hacking into them, and more people were doing important functions on their phone, like banking and other things. And so they had this idea that we need to protect it the same way that we protect computers. So everything from firewall, antivirus, I need to back up my data on my phone. If I lose my phone, I need to be able to find it on a map. All things that we know today are built into the phone. But when they presented this vision for the business and what they'd built, I got really excited and said, yeah, sign me up. I'll spend 6 months helping bring this to market. And they had some early users on the product, but it was still pretty small. So I ran the survey that I mentioned earlier, and only 7% of the users said they'd be very disappointed if they could no longer use Lookout. And so I was like, okay, I've committed to 6 months of working with these guys, and pretty much nobody is telling us that it matters that much. And so as tempting as it was to run, I decided to see if I could make a go of it. And so I dug into the 7% and found that they were focused on one specific use case more than any other, and that was the antivirus use case. So I specifically gave them a choice, what is the primary benefit that you're getting from this product? And when I drilled into people who picked antivirus and protecting my phone from viruses, I looked at, it was about 40% of those people said they'd be very disappointed. So I took that insight and essentially repositioned the product as an antivirus product, streamlined the onboarding to quickly have them set up antivirus, and not just set it up, but say you're now protected from viruses. And so that was really fast. They didn't have to build anything. It was more about narrowing down the offer. So it literally took 2 or 3 weeks to do all of that. Surveyed the next group of people who came in and signed up, and the entire cohort was now at 40%. 6 months later, the entire cohort was 60% of people saying they'd be very disappointed without Lookout. And then Lookout reached a $1 billion valuation within about 4 years. And so, this was a company that I didn't think was going to go anywhere, and it ultimately went somewhere. So now, what's more relevant to you guys is what happened to Lookout when the phones built all of that into the phones? They must not be around anymore, right? Well, it turns out that they continue to use this process of honing in on where the value was in the customer's eyes, and today they're still a successful business, but they've essentially evolved to protecting corporate networks, knowing that the most sensitive part of a corporate network is people's personal devices that they bring into the corporate network. And so they've repositioned on that, and they've continued to thrive. So I think having that feedback loop can be really powerful for a company later as well to stay agile and in sync with the market. So then leadership is ultimately about designing the system that allows you to stay in sync with the market, to continuously learn what works, and to build momentum around what works. And so as much as leaders want to focus on the outcome, the outcome is really more of a function of doing a lot of things right than it is specifically focusing on the outcome. The outcome happens when all of the different pieces are working together, when we're acting on those feedback loops, when we're finding points of leverage and being able to drive improvement in the areas of the business that really matters. And it actually reminds me of sports growing up, where in football, having coaches essentially say, the scoreboard will take care of itself, focus on the process. I think it's the same thing here. Like, the scoreboard is the outcome, is the result, but you focus on that continuous learning process and staying in sync with the market, and you're much more likely to hit the desired results than simply putting a big number and say, let's hit it. And so we want to make sure that leaders are controlling the conditions that support growth. And the number one condition, as we've talked about, is product market fit, is making sure that you understand how your product fits into the market, who it's a must-have for, why it's a must-have for them, and continue to stay in sync with that as the market shifts over time. So before we open it up for the Q&A session, what I want to take away here is a few things as you're building this growth operating system. First, you should be continuously revalidating product market fit. And it's not simply running that question that how would you feel if you could no longer use this product. So I met with a team a couple weeks ago who I had introduced that question to maybe 10 years ago, and we did some light advising about 10 years ago, and they came back and they said, we're doing $1 billion a year now, and we're continuing to run that question, and you want to come in and maybe do some work with us. It's not my normal area, but I said, let me take a look at some of your survey results and see if there's a way that I could be helpful. And when I looked at the survey results, they were simply running that question with a, why did you select that as an answer? And so they were able to see that they've maintained a 40% across their user base, but the why did you select that as an answer didn't provide enough context to help them understand what product market fit they actually had. And if you don't understand why you have product market fit, you can't adjust very well to an evolving product market fit over time. And so that was probably the biggest red flag that I saw in how they were approaching it, was that they didn't really contextualize it that much. And so that's the important thing, is to continue to monitor why people love you and not just that people love you. And then the execution piece is really about running those continuous feedback loops. And so one of the big things that I constantly have when I'm joining a startup is just even changing the language inside the startup, that I want people to talk in hypotheses, because the minute they say, this is what customers believe, this is how things work, they stop challenging it. But when they say, I have a hypothesis backed up by this data, I think they approach it a little bit more flexibly. So even some of the language that people use, and then being able to really evaluate progress more in the number of tests that are being run than in the things that you're doing. So even if you're doing a lot, treating them as tests with a feedback loop so that you're learning from each thing you're doing, I think you're much more likely to dial into opportunities and maximize against those opportunities over time. And then the last thing is something I could talk about for a really long time, but I'm going to introduce it, and then in the Q&A we can go into it in more detail. But one of the most important concepts in growth beyond product market fit that startups think about is something we call a North Star metric. And the North Star metric is really quantifying the units of must-have value that are being delivered, which sounds probably a little bit confusing saying it that way. But essentially we've said, all right, you need to have this must-have value to be able to drive sustainable growth. If you can quantify how much of that you're creating, and that's what you're keeping all of your efforts focused on, you're more likely to be able to drive growth over time. So it usually works best to have a couple of examples around that. So Uber, for example, looks at weekly rides. They could look at revenue, and revenue is more of the output, but they know that the unit of value they're delivering is if it's a 5-minute ride or a 1-hour ride, the person got where they needed to go. And so they're essentially saying, how many rides do we deliver per week in this market, in this country, overall, and knowing that they're making progress the more rides that are being delivered. So for Airbnb, it's nights booked, but it's taking it down to the unit in the customer's mind about how they see value and making sure that you're driving more units of that value over time. And so the more that everyone's focused on moving that metric and understanding the inputs that move that metric, the more likely that you are to be successful over time and drive sustainable success. And so one interesting last thing I'll leave you with is a conversation that the founder of HubSpot is a guy who I've known for a long time, and he shared a story where he was at a dinner and sat next to Elon Musk and asked Elon, he said, you've been a part of all these great companies from PayPal to SpaceX and Tesla and all the other ones. You clearly have figured out growth. What is the key to growth in your mind? And he came down to really this concept, which he essentially said, everyone in the company is essentially a vector, and when people are not pointing in exactly the same direction, their work is offsetting each other. But when you can get them all pointed in the same direction, their work becomes additive. And this is really how you decide the direction for all of them to be pointed in. So hopefully this gives you a little reframing on how to think about growth, and we can dig into more details about how you can apply it specifically in your situation. But thank you very much.
What's seemingly a paradox of you hear an event like ADDO Gathering being themed around the idea of make guests feel something, and then you have like a pretty like scientific methodology as the first session. But I just want to like quickly anchor on like the pivotal question is, how would you feel if you could no longer use this product? Yeah. And I love the idea of like the merger between like the quantitative and the qualitative, the data-driven scientific mind, and then the like, this is about human beings making emotional decisions. Yeah. How do you think about like that paradox and reconciling the two?
Yeah, I mean, ultimately the data will tell you the what, but if you don't understand the why, you can't really control the result going forward. And so I think to me, that's the marriage of qualitative with quantitative, particularly when you can start to segment the quantitative around a result, like you can with this survey. But it's the same thing. Like I'll give you another example from an experiment that I ran with LogMeIn in the early days. We were one of the first freemium businesses, so having a free version and a paid version. And I had a bunch of people who were coming in and signing up for the product, but at the download step, we had about a 90% drop-off rate. And so I was very much in the just test until you can improve it. So we probably ran 10 different experiments, barely moved the needle on that drop-off rate, and then finally said, these people are registering. We have their information. Let's ask them, why are you signing up and not downloading? And when we asked them, we saw the theme keep coming back in this open-ended question, which was, I don't really believe this thing's free. And so, okay, now we know the problem we're solving against. And at dinner last night, we talked about this famous quote from 100 years ago, a problem well stated is a problem half solved. So now we could state the problem, and our next experiment increased the conversion rate at that step by 300%, because now we knew we were solving for people don't believe it's free. So our experiment was, let's give them a choice at that step, download the free version or download a trial of the paid version. And once they saw we had a business model, once we gave them a little insight into what we were doing, suddenly the free version looked attractive to them. So that's an example of the qualitative actually helping to improve a quantitative result.
One more question before we open it up. We were at dinner last night, and Bart asked you the question. It's kind of like the elephant in the room of, hey, like you've lived in startup world with SaaS and tech companies. What's your hypothesis on how transferable a lot of the methodology is to more of like a brick and mortar or traditional retail environment?
Yeah, I think it's very transferable, because ultimately this question, when I came up with it, I came up with it for a single company. It was I was going to ask a customer satisfaction question, but our primary customers were kind of senior management in companies, and a good senior manager is never satisfied, so I don't want to ask a satisfaction question. So I flipped it and I said, how would you feel if you couldn't use this anymore? Because if they don't get what they want, senior management's usually pretty disappointed. And so the signal that I got out of that was really valuable in that business, but I continued to run the question and share it with others, and found that it was really valuable across all of tech. But the podcast that you heard me on, the reason I was invited on that podcast was that a few weeks before, the chief product officer for the world's fastest growing bank had been on the podcast, and he had been talking about how valuable that question was for every product that they were launching, starting with credit cards to everything else that they dial in. They dial in their services. They want to. He said it's a Brazilian bank called Nubank. He said, Brazilians are pretty optimistic, so we look for at least 50% before we scale something, and so he said that was a really like powerful question, and so that was the first time. What was interesting is only a few years before I had presented to banks, and they told me everything, the banks would be in the audience. They'd say everything you're talking about just doesn't work for us in banks because we're a highly regulated environment. You can't run experiments in a highly regulated environment. But this one bank who grabbed onto one piece and really acted on it become a super fast growing bank. So I think a lot of this comes down to the imagination of how do I apply it in my situation. And maybe you can't do it exactly like a tech company, but there are probably parts of this that can.
All right, we'll go hands raised for questions. Madeline has the mic.
Thank you. Could you talk more about how you ask that question of clients? Is there a frequency? Is there a certain time that's the best time to ask that question? Do you ask the same set?
Yeah.
Could you talk more about that?
Sure. So for me, I am asking that there's like a few criteria that I look for. I want to make sure that they're not kind of one and done customers, because obviously I already know that they don't care that much about the product. So I'm looking for at least a couple of interactions with the product, and then also recency. I want to make sure that they've used the product in the last couple of weeks, because if they've already churned, again, I already know what the answer is. And then I'm taking a random sample generally of people who meet that criteria, but I don't need to run it against the same people each time. It's generally a new set of people that I'm doing each time. And if it's a tech startup that is rapidly evolving their solution, I'll generally do it on people who've experienced the new version of the solution instead of people who maybe have been a part of that evolution over time. But it's really a random sample. Like, so the biggest criteria are they have used it recently, they've used it at least enough times to kind of form an opinion about it, and if it's a random sample of those. But I've done it as pop-up ads on a mobile or on a website, kind of pop-up surveys, but I've also done it as email, so it doesn't, the distribution of it doesn't matter as much. But again, like this company that I mentioned that had reached $1 billion in recurring revenue, they only had it as essentially that one question with an open-ended why. To me, the art is, even if they were doing it like that, I would make sure that at least every 6 months they were running something that was a bit had a bit more context to it. So 7 or 8 questions that allowed them to really dig into the why and be able to run some of those segments.
I'm curious how you take what Carrie's talking about, take the question and then apply it to how you market something and then how you operationalize it. Aaron, I'm wondering if you could share your Sweet Green story and then get Sean's thoughts on that.
Yeah, so we actually, I think, talked about this at lunch a couple months ago. Sweet Green, Garrett and I were talking to the co-founder of Sweet Green, and it said, was it the Harvest Bowl? It says if a first-time guest comes into a Sweet Greens and orders the Harvest Bowl, they're like 8 times more likely to return than if they order any other menu item. And the parallel in my mind was like how you design for speed to value and the aha moment.
Yeah.
So I don't know if that's where you're going, but I might even hijack the question. And once you get an indicator and a signal on product market fit, thinking about getting the aha moment and designing backwards from there.
Yeah, so that's like the biggest conversion event that I'm looking for in the acquisition of a new customer is the aha moment, figuring out how much of an experience do they need with the product to be able to say, oh, I get this, and they want to keep using it. And so some products like Slack, if you think about the company collaboration system, you don't get there on one person. It's a lot more complicated. And so for them, they know that product doesn't come alive until there's 2,000 messages that cross, whether you have, just a few people that are doing a whole bunch of messages or a lot of people that are doing a few messages. It's about those 2,000. So a lot of times you can see it in at least a correlation to long-term retention, but ultimately, like when I'm trying to figure it out for a business, I'm starting qualitatively. I have a hypothesis that this is the experience they need, and then I'm hoping I can at least prove the correlation. The causation's a little harder to prove without experimentation, where maybe you remove that step or don't. But yeah, so in that case, like knowing if Sweet Greens knows that it's that particular meal, then that's a good one to send a coupon out on for a first time use. But if they only discount that meal, then it means people just keep coming back, and it doesn't help the second or third time as much to have them do that. So how do you shape that first experience? And in digital, it's a lot easier to shape that first experience because you have exactly who the customer is and the history. But with the physical world, it can be a little harder to do that.
Can you quickly hit on? I might be hijacking a question here. The quick follow-up would be how you think about thematic clustering of the qualitative answers to get to like definition of that aha moment. You hit it in your talk a little bit, but just one more time. Did you think about like taking qualitative feedback and thinking about like categorizing it to force getting more narrow? Does that make sense?
Yeah, I don't try to narrow it down through the surveys on something like on something like an aha moment. I'm really personally more just looking for the signal. So like not having the signal, the hypotheses of what it might be, and figuring out what is that first experience. So like with LogMeIn, it was the first time they did a remote control experience with the product. They had experienced it enough to know, okay, this is what. So I could kind of figure that out without survey data, but to me, it's a lot more in the data to be able to see, is there a long-term retention that is tied to that? Yeah, I think that's like shaping that first experience and thinking, what experience do I need to get them to come back and continue to use the product?
Yes, Sean, just to build, I think you spoke a lot about the frequency and approach to revalidating product market fit. If we apply that same question to the second one, turns execution into learning, I'd be curious to know, with the speed that I imagine the context from which we execute in is changing exponentially, and in digital with algorithms and different things faster and faster and faster, how do we go about approaching continuous learning where we understand that what might be a true positive could actually be a negative moving forward? So how do we look at knowing how to kind of feedback loop in positive, but know when to let go of what might have worked in the past that no longer is going to be working?
Yeah, so I mean, I think the big picture of product market fit is you can do it on a less frequent basis, but it's more about every single assumption you have around these are the things that drive us forward, being able to go back and just make sure you're not getting that atrophy in channels, and if you are, understanding why you're getting them there. But to me it comes like, I used to sell print advertising 25 years ago, and at that time it was not very like correlated, does this work or not? But we had a great quarter. Whatever our media mix was last quarter, we don't want to mess with it. We want to make sure we do the same stuff. And obviously, like we have more cause and effect today, particularly in digital. And for a lot of you guys, it's going to be a little harder to make that connection. But even with LogMeIn and some of the, like by the time I left LogMeIn, we had 100 million devices on the platform, and 100,000 new people a day signing up, and majority of those weren't tied to a specific marketing campaign as they were coming in. It was a lot of word of mouth, organic growth, other things that were driving it, and so it was more of a triangulation of what do we actually know, and then being able to survey, how did you find out about us, and being able to bring that survey information in there, and being able to do, turn off some things, see if it like affects, turn them back on, and just so it's more of triangulating on the information. But I think it's holding yourself accountable to knowing what has worked previously may not work as well going forward. But the specifics of how you do that, I'm not sure I have any more insights on that for your business than you would have.
Question for you. You mentioned the Lookout 7% and how that change took place. Can you speak to the change management or alignment strategies when you discovered it was antivirus to get everyone to move in that direction?
There's a reason why I focus on super early stage startups, is because it's like I got all 7 people on the same page in about 15 minutes. Yeah, I think, but even for me, like part of it is if I said, hey, it turns out that customers don't value any of this stuff, that 80% of your effort has been building stuff that customers don't value, like even 7 people are going to balk at that. So to me, it was more about how do we introduce them to the product rather than let me change the entire product strategy and cut out all that other stuff. It's like, this seems to be what they love. If over time we want to cross-market the rest of the suite of tools, that's fine, but this is what I want to onboard them with. So they tend to give me a lot more flexibility if it's messaging and onboarding, but even like messaging, if it's like homepage messaging, everyone has an opinion. But if I'm controlling the marketing campaigns, I'm generally not sending them to the homepage. I'm sending them to a landing page, and so I can shape that perception in a way that most of the rest of the team doesn't even see it anyway. So. But the onboarding piece definitely required them to be bought in, because that required real product work. But I will tell you that in the larger companies that I've worked with, we talked about this yesterday as well. I've said that for the first maybe 2 weeks, I come in and there's this honeymoon period where everything I say is brilliant and they want to do it. And after 2 weeks, I'm just another pain in the butt telling them to do things they don't want to do. And so if I have like a 2-week window to really drive change, and at least like a change of perception and an approach, I try to really kickstart that. So I'll do about a week of kind of deep dive into customer data, and then a full day workshop with all of the key people to present that data, try to adjust the perception around that, talk about a better way to execute the business going forward, and really trying to just like kind of kickstart that habit as opposed to let it gradually evolve. And so, yeah, I for a long time refused to do any hands-on work unless they agreed to do the workshop up front.
Sean, once you determine you've got the 40%, the people, product market fit, how do you determine the size of the market itself? Because at that point, I'm assuming you just got a really small sample. So how do you extrapolate from there to determine the size of the market? That's it's worth going after? Particularly
when it's, most of my time is like bringing early stage tech to market. And so that's really hard because, Uber's the classic example of, is it the taxi market? Is it the limousine market? And then sometimes those new capabilities open up all these things that it actually cuts into the rental car, and so I ultimately, I think the real challenge with that happens when, if I'm running the segments and let's say I find this benefit has like 80% of the people who pick this benefit say they would be very disappointed without the product. Then there's another benefit where if people pick that, it's more like a 40%, but the majority of people are bucketing on this 40% one. Then it's like, do I go intense need, maybe more niche market, versus broader need but still good enough? And that's a lot of times just a conversation with the founder, CEO of like, strategically which direction to go in. Personally, I tend to, especially in tech, I tend to go for the intense desire and need for the product in a smaller market, knowing that if I have traction there, that I can build out from there, where traction's probably the hardest thing in a startup. For you guys, like, you need pretty big markets to move the needle in the business, so it could be a little bit different. But I'll tell you, like with LogMeIn, I had to do a market site. I identified pretty early on, so LogMeIn started as we had this hypothesis that people needed to remotely access their computer from anywhere else, and that it would be non-technical people. We make it really easy to use, and they they just essentially wouldn't need to have their computer with them all the time. They could go in through a web browser from any computer, and especially for like small business owners and things, it gives them a lot more freedom and flexibility. And that was like our hypothesis going into it. But we discovered this use case that we hadn't anticipated, where it was actually a lot of outsourced IT support people, that it was so easy to use that they could walk their client through on the phone and say, hey, just install this thing. I can take over your computer and control it. And at the time, I thought there was a really big opportunity there, but the investors were questioning, is the market big enough? And when I tried to size the market, it was impossible to size, because it turned out that most of the people who were providing that remote support were doing it sort of on the side while they had full-time jobs. So it was like a very kind of shadow economy thing. And so the way that we ultimately sized that market was, we said, okay, for all these sub 10-person companies, how many computers are in those companies? How many computers can a remote support person handle today? And then trying to just kind of go on a ratio, working backwards from the computers to identify. And that ultimately became like half of our revenue came from that group of people, and the business sold for about $6 billion. So I think it was the right move, but even trying to market size it, it was pretty tough at the time. I mean, ultimately, I think it comes down to, I want to figure out my most passionate customers, what's the common thing that they care the most about. And so we were talking last night. I mentioned sounds surprising around here, but I had my first Chick-fil-A experience a couple of weeks ago. Just, we don't have that many of them in California, or they're relatively new still, and I'm not generally like a fast food guy. But on a long ski drive, I stopped in, and it felt different the minute I went in there, and it felt different in the way that's reflected in a lot of the TV commercials, that it was a more friendly, wholesome kind of environment. And so I think that's an example of a business that is very like in sync with their unique identifier. And another thing we talked about last night, though, was like Southwest Airlines. They've been one of the most profitable airlines over many years, and they just eliminated their kind of whole seating policy to be more like all the other airlines. And I talked about kind of some fear there of like, are they, I don't know, from myself, like I kind of like the quirky weirdness things that Southwest Airlines has, but I also don't fly them as much as I used to. And so maybe others have kind of moved away from that, but it felt like a scary move, and I would just want to make sure that they deeply understood the essence. But at the same time, like it would come all the way back to the BlackBerry example. I loved it for the keyboard, and then I switched when innovation changed my perception of what I needed. And so I think just being rooted in why customers love you, I think you do need to say, if I'm losing a lot of customers who previously loved what I was doing, then how do I reconcile those two things, that maybe the goalpost has moved and I need to reposition on something else? And that's, if there was like a simple cookie cutter way to do all of this, life would be a lot easier. It is a little messier than I think any of us would like, but it's also keeps it pretty interesting and challenging and fun.
Can you all thank me? Join me in thanking Sean Ellis. Thank you.